So on this chart, I've got the Nikkei, which is the candle chart, and then I've got the green line chart, which is FXY, which is the ETF for the yen. And I've inverted that. So we can see that as the yen has weakened throughout the course of this year, the Nikkei has rallied, right? That tends to be the correlation that we have. As yen weakens, it's good for Japanese exports. Nikkei stocks do well. That kind of has been a relationship from the start of the year into the summer. But that was when we had a bit of decoupling. And so what we've had since then is the dollar yen has continued to rally. So the yen has continued to weaken. And that's even after the Bank of Japan loosened their band on yield curve control to 1%. So the expectation of the market was that if they loosen their band, that's going to be yen positive. The yen's going to strengthen sharply. And that may also be met with a bit of Nikkei weakness. Instead, what they did is they loosened the band, but they said we're still going to intervene as and when, and we're going to buy bonds as and when we feel like it. So it's kind of a controlled, they're controlling that gradual ascent of JGB yields from 50 bips up to 1%. It's about 85 bips right now. But the fact that they're still in there, they're not allowing those bonds to free fall. And so they are still controlling that move up to the next level. Now, what happened when they loosened it is the entire global bond market just got kind of unanchored, and you saw treasury yields explode higher to 5%, where they touched earlier in the week on the 10-year, and the 30-year yields went crazy as well. So the move in US yields was so much bigger than Japanese JGB yields. That is supportive of dollar yen. Remember, dollar yen moves to some extent on yield differentials. And so we saw that yield differential still move in favor of dollars. And so dollar yen was actually higher, not lower, as we initially might have thought. But then as dollar yen went higher, the Ministry of Finance in Japan are like saying, we don't want this thing blasting through 150, either through verbal intervention or actual intervention. And so you've seen this thing chopping in an incredibly tight range around that 150 level on dollar yen. And it's really struggling to do anything around here. Realized vol has collapsed to 3% on dollar yen, which is about as low as I've seen it in a very long time. So you've got that going on in the yen. And then looking at the Nikkei, after that topped out in the summer, it's been this big consolidation pattern, but it has put in a bit of a double bottom at a key Fibonacci retracement level just shy of 31K. So whilst it might have some more room to the downside, the Nikkei, before it's done, this does very much look like a consolidation of that big rally since the start of the year. And therefore, the Nikkei at some point, I think, will resume its rally, right? And if Warren Buffett's in the trade, I'm not going to go against him, right? He thinks Japanese are alone, and technically, the uptrend still looks intact. So that's kind of the setup for Nikkei. Looks like it's carving out a bottom, and dollar yen vol has just gone to zero, and I don't think it's sustainable, right? I think this dollar yen is artificially being held at 150, and at some point, either through Bank of Japan action or the Ministry of Finance letting it go, I don't know, we're going to get some sort of break of the elastic band, and this thing is going to go. That is my impression. So that says to me, I want to pick up potentially some of this cheap dollar yen vol. So now let's look at the idea. The idea is basically looking at the relative value between Nikkei vol and dollar yen vol. So these two charts show implied vol and realized vol for these two assets, right? So you've got the Nikkei vol in white, you've got the yen vol in orange, and then you've got the ratio of the two. So you can see the ratio of the two vols between the equity and the FX pretty much at the year highs at 2.4. So that's saying that Nikkei vol is 2.4 times dollar yen vol, which is in the 99th percentile, basically. It's pretty expensive, okay? If you look at realized vol, though, it explains why, because realized vol has just gone crazy to the point where it's 4 times, right? Realized vol on Nikkei, 4 and a bit times realized vol on the yen. You've got this 20 odd on realized Nikkei realized, and you've got about 5 on a 20-day basis on realized vol on the yen. So I don't think this condition is sustainable, right? I want to buy dollar yen vol, but the problem is it's realizing so little that even though it's at its lows, it's still got very bad carry if I pay theta for this waiting for something to happen. So actually the idea is financing some of the cheap dollar yen vol with expensive Nikkei vol, because Nikkei vol is actually trading high range which you can see from here, that white line is trading up at the high end here. So you can sell some Nikkei vol, earn some premium off that, and reinvest that premium in what looks like a ridiculously cheap dollar yen vol. And if dollar yen does then move away from 150, you're going to get a pickup in vol, you're going to get a move in that thing, and the Nikkei vol is already quite expensive and highly priced that you don't necessarily lose money on your Nikkei leg, right? That is the idea. So in terms of actual trades that I would do, because I've got a bullish bias in Nikkei, I would sell put spreads on the Nikkei.